Welcome to the online platform Education Unlimited. Today we will look at ratio analysis, the accounts topic ratio analysis. I hope that you'll enjoy this presentation. The five main categories of ratios are profitability, liquidity, efficiency, shareholders, and capital structure. In this presentation, we will use the statements given to calculate the following ratios, and we are asked to show the workings. The first ratio we will calculate is the current ratio. The second ratio is the acid test, also called the quick ratio. And the third ratio that we will calculate is the return on capital invested. The fourth ratio is called the rate of stock turnover, and the fifth ratio is called the net profit percentage. We will calculate this from the trading and profit and loss account, also called the income statement, and the balance sheet, also called the statement of financial position. This question is taken from the CSEC past paper May-June 2006 on the subject, the principles of accounts. The first ratio that we will calculate is the current ratio. The formula for current ratio is current assets divided by current liabilities. We pull from the balance sheet, also called the statement of financial position. The total for the current assets is $15,010, and the total for the current liabilities is $700. So we divide $15,010 by $700 to get an answer of 21.44 times. 21.44 times. So this means that the business can pay off its current liabilities 21 times. So this is a very good current ratio. The second ratio that we will calculate is called the acid test ratio. It is also called the quick ratio. Both the current ratio and the acid test ratio are liquidity ratios. So we pull again from the balance sheet, also called the statement of financial position. We pull stocks, also called inventory, which is $810. We will pull prepayments, which is $1,350. We will pull the total for current assets, also $15,010. And of course, we will pull the current liabilities, which is $700. The second ratio that we will calculate is the quick or acid test ratio. The formula for this ratio is current assets minus inventories or stocks. However, in this particular problem, we also have prepayments. Prepayments must be subtracted from the current assets figure because to quickly get that liquidity in a crunch position, or if the business was supposed to be wounded up, we cannot include inventories or prepayments. So the formula reads current assets minus inventories and prepayments, all divided by current liabilities. So the current assets is $15,010, which we had pulled from the balance sheet. The inventories, also called the stock figure, $810, and the prepayments, $1,350. To give us on this side $15,010 minus $2,160 to give an answer of $12,850. The current liabilities, just as in the previous question, was $700. So we divide $12,850 by $700 to get an answer of 18.36 to 1, which means that the business can pay off its current obligations without the use of inventories or prepayments which were already paid 18.36 times. Remember, both the current ratio and the quick or acid test ratio are measured in times. They are ratioed, so this one is measured 18.36 to 1. Third ratio that we will calculate is called the return on capital invested. And the items that we will pull are the net profit from the income statement. We will pull the opening capital from the balance sheet, and we will pull the closing capital also from the balance sheet, because we need to have an average of the capital figure, which is the opening capital plus the closing capital divided by 2. So the formula for the return on capital invested, which is also called return on capital employed, is net profit divided by capital employed or invested. And when we get that answer, we will multiply it by 100, because unlike the liquidity ratio, this ratio must be expressed in percentage. So another name for the net profit is net operating profit after tax for those of company accounts. So the total for the net profit in this question was $29,860. The opening capital was $21,110, and we add that to the closing capital of $14,370. We divide it by 2 because we need an average for the capital figure. The total here would be $35,480, and we divide it by 2 to get the answer of $17,740. Now, to get the answer, we divide the net profit by the capital employed to get 1.6832. We multiply that by 100 to get 168.32 percentage. This one is the return on capital employed, and this is a profitability ratio. So the fourth ratio that we will calculate is called the rate of stock turnover. We will pull this from the trading and profit and loss account, and we will also pull it from the balance sheet. We will pull the opening stock figure, we will pull the closing stock figure, and we will pull the cost of sales figure, which is also called the cost of goods sold. We must also note that the closing stock figure of $810 is listed in the trading and profit and loss account, and it is also listed in the balance sheet. So the formula for the rate of stock turnover is cost of sales divided by average stock. Rate of stock turnover is an efficiency ratio. We looked at liquidity ratios, which were current ratio and the quick or acid test ratio. We looked also at the profitability ratio, which was the return on capital invested, also called the return on capital employed. So we pull from the income statement cost of sales of $80,940. We pull the opening stock of 680 and the closing stock of 810. Note the closing stock is listed in the trading and profit and loss, and it is also listed in the balance sheet. So we get a total here of $1,490. We divide it by 2 because we need the average stock. So we now divide the cost of sales of $80,940 by $745 to get an answer of 108.64 to 1. Again, this is measured in times. So the stock turnover 108 times during that accounting period. This was a very good turnover of stock for the business. So the final ratio that we will calculate is the net profit percentage, which is net profit divided by the sales figure, and we multiply it by 1, just as the return on capital invested. The net profit percentage is measured in percentage. So the items that we will pull from the TP&L, the trade and profit and loss, which is also called the income statement, we will pull the sales figure and we will pull the net profit figure. So the formula for the fifth ratio, the net profit percentage, is net profit divided by sales multiplied by 100. The net profit percentage is a profitability ratio, just as the return on capital invested. Therefore, it is represented in a percentage figure. So we pull the net profit of $29,860 and the sales figure of $154,610 to get an answer when we divide of 0.19313. We multiply that by 100 because we must list our answer as a percentage. So the answer is 19.31%, meaning that out of every dollar of sales, 19.31% is remained as net profit, or 19 cents of our sales figure of every dollar is remained in the business as our net profit. These are 5 types of ratio that we looked at today: the current ratio and the acid test ratio, which were liquidity ratios. We looked at the return on capital employed, also called the return on capital invested, and the net profit percentage, which are profitability ratios. And we look at the rate of stock turnover, which is an efficiency ratio. We must not only know the calculation or the formula for the ratio, we must also know what each ratio represents. In our next presentation on ratio analysis, we will look at what each of these ratios represent. Again, this was taken from the CSEC May-June past paper question in 2006 on the subject, the principles of accounts. Remember, you may like, you may share the videos, and you may hit the subscribe button to subscribe to this channel, the online channel in math and accounts for colleges and high school. EDU Unlimited, Education Unlimited, as we continue our surge into math and accounts. Have a very good day.